Good afternoon, everybody. Can you hear me?
Yes.
Okay, thanks, Diane.
Yes.
All right, we're going to give it a few more minutes before we get started. Welcome.
Welcome.
Well, thank you. How are you?
Doing well today. One more day and it's Friday.
There we go. But who's counting? Just another minute. Expecting a few more people yet? Okay, I have 12 o'clock. So welcome. Let's go ahead and get started. My name is Christina Samaglia. I welcome you to course 4 of the CHFP training session. I'm filling in for Christine Fontaine today, who had to travel. A few housekeeping items before we get started. Everyone is on mute during the presentation. Please turn off your video if you haven't already so we can maximize presentation streaming. Any questions you have, please enter them in the chat box. We'll make every attempt to answer these questions during the session. But if we run short on time, we will reach out and get back to you. Also, as you know, today's session is being recorded and materials will be posted on the website. Again, the information being provided today is a simple review, and thus you are encouraged to study the materials further on your own to help you better prepare for the exam. So today's learning objectives. Oopsie. Bear with me, guys. Sometimes these things are a little bit, there we go. Can you all see that? So today's learning objectives are to describe how strategic planning influences budgeting, differentiate between the various budgeting approaches, define different types of budgets used in a healthcare business, and identify budget variance concepts. So the context for successful use of financial statement data comes from planning and budgeting. Planning entails the preparing of the business for future operations in a big picture sense. Budgeting is a subset of the planning process and is intended to express the organization's plans in financial terms. So the basis of strategic planning is to provide an essential part of management of the business and sets the general framework for what an organization is in the business to accomplish and how it intends to accomplish what it has set out to do. Failing to plan forces a manager to react to immediate crises rather than run the business with a clear set of goals and priorities. This type of situation, although common, nearly always leads to less than optimal outcomes and the potential for the business to fail. Strategic planning starts with fundamental steps that include a mission statement, vision statement, and the overarching strategic plan. So again, strategic planning starts with a fundamental premise. And that is, what is it that the business intends to do? Or what is the purpose of this business? This is the essence of the mission statement. Literally, what is the purpose of the business in terms of delivering a service or selling a product? A mission statement may be expressed in multiple parts, such as the mission of XYZ Hospital is to provide high-quality care in a state-of-the-art facility that emphasizes the human element of the healthcare. Closely linked to the mission statement is the vision statement. The vision statement is used by some organizations to concisely express the organization's aspirations. An example of a vision statement for a community health center might be to be the leading source of care to the medically vulnerable and underserved. Once equipped with a sense of the mission and values of a business entity, managers can set out a broad plan to guide the organization toward fulfillment of its mission. This is usually carried out in a strategic plan, which is a long-term view of the future, at least a year, and often ranging up to 10 years into the future. Now, a strategic plan describes the current state of the business, including its strengths and weaknesses, opportunities and threats, as well as any specific organizational objective and action steps for achieving those objectives. The strategic plan becomes the foundation for budgeting in the healthcare business. In many respects, an organization's budget is an expression of its strategic plan in numeric terms. The budget then defines the organization's plans for earning revenues and using resources over a given period of time. Okay, that brings us to our first polling question. Let's say XYZ Hospital is about to begin its annual budget. What document should it rely on to guide them? I'll give you some time to answer the polling question. I'm going to give it a little more time. I see some people are still answering. Okay, we have about 50% participation right now, but we're going to go ahead and answer that question. And the answer is 4, number 4. The strategic plan, because it describes specific actions that the organization hopes to undertake, and the budget expresses those goals in numeric terms. Many management experts say that a budget is simply a strategic plan expressed in numbers. Happy to say that 100% of you got that question right. Okay, the budget, the strategic plan becomes the foundation for budgeting in a healthcare business. In many respects, an organization's budget is an expression of its strategic plan in numeric terms. The budget defines the organization's plans for earning revenues and using resources over a given period of time. Oops, let's go back. I'm sorry about that, guys. I'm going to go back one more. Oh, I'm having issues here. Are you all back with me?
Yes.
Yes.
Okay. Okay, so basic budget concepts. A critical element of working with a budget is understanding that it is a management tool, not a financial tool. Budgets set targets and objectives based on a plan set out by management. Budgets are useful in helping managers better control operations in their healthcare setting. Values in the budget can be used as a benchmark against which actual revenue and expense results can be compared. Comparing actual results with budget targets can help managers identify areas where performance improvement is needed. If revenues are below expectation or expenses are above budget targets, identifying those differences can guide managers toward potential problem areas and help to focus corrective action where it is most needed. Usually, the budget for a healthcare entity is based on a forecast for the coming year. However, monitoring progress toward organizational goals on a year-by-year basis is generally ineffective, as unfavorable changes in financial performance could remain uncorrected until they have already had a significant negative impact. Generally, an annual budget projection is broken down into quarterly or monthly segments, and those annual subdivisions are used for ongoing monitoring and control in a healthcare business. So we have top-down versus bottom-up budgeting. The process by which a budget is prepared varies depending on the size and management style of the entity. This chart illustrates some differences between top-down and bottom-up budgeting approaches. As you look at this, key points for the top-down are that prior year results are reviewed and adjusted based on future expectation. In bottom-up budgeting, projections are started without using past experience, and because of that, they can be labor-intensive, much more labor-intensive than the top-down approach. Okay, we're to our next polling question. The management of XYZ Health Plan operates in a fairly centralized manner, with most decisions being made by the CEO, CFO, COO, and the board of directors. Given the management style, which of the following budgeting approaches would XYZ Health Plan use and why? There's quite a lot to read here, so I'll give you a little bit more time to answer. Okay. And the answer is C. In a top-down approach, management makes decisions about the budget and shares them with the frontline employees. Very good. Both polling questions, 100%. Okay. Usually the budget for a healthcare entity is based on a forecast for the coming year. However, monitoring progress towards organizational goals on a year-by-year basis is generally ineffective, as unfavorable changes in financial performance could remain uncorrected until they have had a significant negative impact. Generally, an annual budget projection is broken down into quarterly or monthly segments, and those annual subdivisions are used for ongoing monitoring and control in a healthcare business. Okay, approaches to budgeting. We have incremental budgeting, which is an approach that can be useful for a business that believes the past results are reasonably predictive of future activity and are consistent with the goals of the business. However, this approach can preserve operational inefficiencies, such as excessive staffing or supply usage, if projections are not critically assessed from time to time. The incremental approach is effective if managers assess each area of the budget for adjustment based on the needs of the business and known changes. Zero-based budgeting is an alternative approach to budget projection and is a zero-based budgeting, where managers start each budget projection as if there were no past experience, and each item in the budget must be justified to its reasonableness each year. The process can be tedious and, again, very labor intensive because you're starting from scratch each year. However, this approach can result in a more realistic and effective budget target, but at a cost of a greater amount of time, effort, and resources to produce it. Some healthcare businesses may combine the advantages of both approaches by practicing an incremental budget on an ongoing basis and then producing zero-based budgets every 3 to 5 years. This method may help an organization prepare a routine budget with relative ease while maintaining critical assessment of the assumptions making up the budget. The key point in budgeting is that it expresses a longer-term plan in monetary terms in one-year increments. This brings us to our next polling question. Budgets can be used for all of the following except Diane, I don't see the polling results yet.
Yeah, I can end it. You ready for me to end it?
Oops. Yeah, let's go ahead and end it. Usually I see a result. There we go. Bear with me, y'all. This is my first time presenting, so I'm having some technical problems there. But once again, 100% correct. The answer is B. A budget is an operations management tool that presents feedback on a service or product's performance financially. And this information is useful to managers in reviewing and adjusting operations. It's important for managers to understand that budgets are a tool and not an absolute number that must be achieved. A budget is used by managers to see if the business is on track towards meeting its strategic goals. And if not, what can be changed to move the organization closer to those goals. Again, the budget is only a projection and therefore has areas of imperfection when compared with actual results. However, when used with a degree of judgment, the budget can be a valuable management tool. Okay, elements of the budget for a healthcare business. Managers often refer to the budget as if it were one document. However, the budget is actually comprised of several components that provide important details useful to controlling various elements of the healthcare business. These components are normally referred to as the operating budget, capital budget, and the cash budget. These budget components may not be separately identified in smaller organizations, such as a physician office. However, the financial planning process for a healthcare business may include elements from each of these budget components. The operating budget provides a benchmark for normal day-to-day operations of the business. Essentially, the operating budget is a future projection of the income statement and includes estimates of service volumes, revenue, and expenses. No matter the organization type, an understanding of the expected volume of services provided, which are expressed in a statistical budget, provide a necessary foundation for other elements in the operating budget by defining the volume and units of service expected to be provided. Once an understanding of service volumes is established, managers can apply expected collection rates to estimated volumes to arrive at a revenue budget. While compiling the revenue budget, managers can make assumptions on the rate of collections for items on the statistical budget. The expense budget is built using results from the statistical budget. Managers can develop estimates of expenses by knowing operational relationships, such as the number of labor hours per patient served, the average time to address a patient billing question, the average amount of medication per patient discharge, or the salaries for executives and physicians employed in the healthcare setting. Determining capital investments is an important next step in the budgeting and planning process since capital investments can be a significant use of scarce resources for a healthcare business. These decisions are detailed in the capital budget. The operating budget is the most common component of the financial plan. It provides a benchmark for the normal day-to-day operation of the business and serves as the future projection of the income statement. The operating budget includes estimates of service volumes, revenue, and expenses. The operating budget typically contains components of a statistical budget, revenue budget, and expense budget. Statistical budget is a projection of service and provides a foundation for other elements in the operating budget. Once an understanding of service volumes is established, managers convert these volumes to collected revenue. While compiling the revenue budget, they make assumptions about the rate of collections for items on the statistical budget and changes in prices for a hospital physician office in contracts with insurers. The expense budget is built using results from the statistical budget. Managers can develop estimates of expenses by knowing operational relationships such as number of labor hours per patient served and time to address a patient billing question. An important element in the preparation of the expense budget is a manager's understanding of the relationship between volume of service and how expenses are affected with changes in the service volume. Cost centers. Support areas that do not generate revenue tend to incur indirect costs and are known as cost centers. Managers within cost centers are responsible for control of the expenses that are not directly tied to revenue generation. The expenses incurred in cost centers are overhead or indirect costs, as discussed in last week's course 3 on cost analysis principles. Now, while costs technically relate to expenditures and expenses technically relate to the consumption of the expenditures, for the purposes of the discussion, they mean the same thing. Again, costs generally do not generate revenues, tend to incur indirect costs, and they're manager-controlled expenses that are not directly tied to revenue generation. Okay, we're at our next polling question. The operating budget is comprised of all of the following except select the best response: the expense budget, revenue budget, cash budget, or statistical budget. Okay, a few more coming in. Okay, and the answer is C, the cash budget. So we had close, little bit close, 38 versus 62% here, but it is the cash budget. The operating budget estimates the projected activity levels and associated revenues and expenses, the operating budget, and the sources and use of cash. Okay, onto the capital budget. After completion of the operating budget, managers can look at capital investments required to achieve the budget goals or the overall strategic objectives for the business. A health plan might want to invest in new computer systems, while a hospital may seek to invest in more efficient diagnostic equipment, or a clinic may wish to add another exam room. The capital expenditure is defined as the purchase of land, buildings, or equipment for use, not resale, in providing services to patients or clients. These items should have an expected useful life of more than 1 year and exceed a minimum cost threshold. Usually this threshold is about $1,000, but that can change depending on the size and nature of the healthcare entity. Capital needs are usually classified as maintenance capital or strategic capital. Maintenance capital are capital investments made to replace existing capabilities, or maintain current service levels, while strategic capital are investments that expand capacity, capabilities, or create new service lines. Managers must set priorities for maintenance and strategic capital based on the availability of earnings from operations, investment income, cash levels, or the ability to incur and also repay debt for capital items. Among the techniques used in capital investment analysis are net present value, NPV, internal rate of return, IRR, and payback period. Net present value estimates the present value of future cash inflows and outflows associated with the asset and subtracts those assets' current acquisition cost. If the present value exceeds the price of the item, the investment has a positive NPV and can be beneficial to the business. That associated IRR gives a percent answer for the capital expenditure when the NPV is artificially held constant at 0. Both NPV and IRR take into account the effects of time on money. The payback period simply estimates the net cash taken in by the business by an investment over future years and determines how long it will take for the business to collect the same amount of cash it spent on the investment. All other things equal, the investment with the shortest payback period receives the highest priority for acquisition. The payback period, as described, is easy to understand, but does not take into account the effects of time on money. So the next polling question, ABC Medical Center has just learned that it must replace its emergency generator system. How would you categorize this capital investment? Well, everyone has been quick to answer this one. I'll give it just a couple more seconds here. Okay, and the answer is A. A hospital needs an emergency generator to provide electricity for patient care if electricity from a local utility is not available. Since it had a generator before and the generator did not produce any revenue, the investment represents maintenance capital. The cash budget. Completion of the operating and capital budget allows managers to determine expected cash needs for the coming year. If the business needs cash to finance operations, perhaps due to slower collection of receivables or increased inventories, or to make capital investments, plans must consider these needs. If the business does not have enough cash to meet all those needs, then financing through a line of credit, leasing of equipment, incurring long-term debt, or fundraising might be needed. These decisions form the basis of the cash budget. Sources of cash include drawdown of cash, income from operations, sale of old equipment, and perhaps gifts from the hospital foundation. Another polling question already. As part of the operating budget, specifying the volume of workload expected during the time period covered. I did not say that good. I'll let y'all read the question. A few more coming in. Okay. And this is actually an example of the statistical budget. Okay, budget variance analysis. Managers may use the budget in managing a healthcare business by comparing budgeted amounts with actual results achieved by the business. The calculated difference between actual and budgeted amounts is known as the variance. When calculating variances in revenue, the budget amount is subtracted from the actual amount. Conversely, an expense variance is calculated by subtracting the actual amount from the budgeted amount. Since most operating statistics relate to items that generate revenue, the same approach for calculating a revenue variance is used for statistical budget variances. It is, of course, also possible to calculate variances by consistently subtracting budget from actual or actual from budget, as long as one remembers if a positive or negative variance is favorable or unfavorable. When you learn about variance formulas later in the course, it can be helpful to adopt a convention to always start the calculation with one or the other. There are two different types of budget variance analysis. The first is the simple budget variance analysis. The simple variance uses the budget as prepared before the beginning of the fiscal period and computes the variances between the budget projection and the actual results. As its name implies, this method is very simple, taking only the difference between the actual and budgeted result. But this may be limited if actual volume differs from the budget projection. Now, in response to the fundamental weakness of the simple budget variance, flexible budget variance analysis requires the manager to adjust the budget for changes in volume by applying revenue and expense per unit standards to the actual volume. The analysis then determines the variance between actual results and a budget projection that has been flexed to the actual service volume experienced. Rate variance, which is also referred to as price variance, is an estimate of how much of a total budget variance is due to the rate per unit of revenue or expense being different than the budget estimate for the entity. This is only one component of the total variance and simply tells you how much of the total variance is a result of price, which is something that may not be controllable by managers. The rate variance is calculated by the formula actual rate or price minus budget rate or price times actual volume. The volume variance is an estimate of the extent to which the total budget variance in a budget line item is a result of actual volumes being different from those used in the budget projection. When combined with the rate variance, volume variance can be very useful to a manager needing to know more about a budget variance. The volume variance is calculated using this formula. Actual volume minus budget volume times budget rate. Benchmarking. The process of benchmarking can be a valuable exercise in gaining further insight to operational performance. Benchmarking is the comparison of key performance measures relative to competition, other organization, or groups of organizations compiled by an industry like the American Hospital Association, the America's Health Insurance Plan, HFMA, the Medical Group Management Association, organizations such as these, which can provide valuable information on key ratios that again will be described elsewhere during the training module. A good example of these benchmarking tools is HFMA's Key Hospital Financial Statistics and Ratio Medians. This is published by HFMA and is available to its members. Moving on to productivity. So performance against financial targets in an operating budget can certainly help a healthcare business maintain its financial solvency. But as noted earlier, the rate and volume of inputs to providing patient care can be important in driving favorable results. In particular, the volume of labor inputs for providing care in a hospital or clinic or in serving customer service needs can be critical in controlling labor costs. Labor makes up the majority of operating expenses in any healthcare entity and in a majority of administrative costs in areas like a health plan. Setting standards for the amount of labor per unit of service, or productivity standard, can be a valuable control tool for managers in a healthcare business. Another polling question. Looking good. So benefits of the process of benchmarking include all of the following except C. It serves as a primary tool for managers to maintain the budget. That is the exception. Benchmarking can assist managers in thinking about activities and improvements that impact the budget. However, benchmarking is not fundamentally a budgeting tool, but rather a performance improvement tool. Strategic finance professionals. Strategic planning is a function that all managers can play a part in. This is especially true in healthcare finance, as financial managers adopt much more of a strategic role in the industry. Not only must financial managers see the bigger picture of the organization strategically from both a business and clinical care perspective, but they must also translate that strategic vision into measurable terms through the budgeting process. Further, through the use of financial management tools such as budget and variance analysis, managers can assess problems with resource use in their businesses and better manage those resources in today's challenging healthcare industry. So to recap, today we worked on identifying how the strategic planning influences the budgeting process, how to differentiate between various methods in developing a budget, the key components of the budget variance concepts, and determining the value of benchmarking to the budgeting process. Now, I know we had an hour booked. Hopefully I didn't talk too fast. Do we have any questions? Okay. Once again, we encourage you to go back through your materials. You do not want to rely on today's overview as your only source of studying for the CHFP. So we encourage you to go back out to your materials and keep studying. And I see there might be something in the chat. No questions. Okay. All right, I'll give you all a little bit more time back in your day, and happy studying for your CHFP. It was fun standing in for Christine today. I'll see you all again soon.